Hi, this is Randy Finney with Right Side of the Chart, and this is an early to mid-session update for Friday, March 1st, 2024. As we start off the trading month, here's what I want to do in this video. I've got a few new things to share, but what I want to do is start with a quick update on some of the recently highlighted trade ideas. Got to mention earnings coming up on CARA. That's important. And then I'm going to go over, I haven't done this in a while. I used to do it on a regular basis or a more frequent basis. And that is to go over the 11 sectors of the S&P 500. As I like to say, an index is simply a sum of its parts. In the S&P 500, yes, there's not a full 500, but close to 500 companies in there. However, take me hours to go over 500 charts. And really no reason. Usually it's the big, the Mag 7, formerly. I'm going to get to that too. But the easiest way, one of the easiest ways too, is look at the 11 sectors. And I want to do that today. Some things I want to show you there. So we're going to cover updates on the recently highlighted trade ideas first. After this, I would start out with QQQ and go over those sectors in Treasury bonds. That's to me one of the most important things right now. Make no mistake about it. You can see the lift in the 10-year today. Remember, we had coming off a divergent low in the 10-year, and market is still, in my opinion, hypersensitive to rates. So let's dive in. Let's not spend too much time on this. This is just another back test. Remember, we've had a lot of volatility, whipsaws, whatever you want to call it, lately with the NVIDIA earnings. We had a pre-earnings breakdown again in NVIDIA. NVIDIA is almost everything right now in the market, but what I'm going to do here is add another line for you. But so we went on, popped above the trend line for really back tested. That was a close, red candle close on it. We had one day with the post-earnings noise, and every other day. Remember, a red candle means you close at the bottom of it. Closed again on the trend line, closed again on the trend line. You can't even see it there. There's a little green doji hair below it, but not again. I said if you have to squint and it's close, then give it the benefit of the doubt, back test. And today we're right on it, at the moment above it, but this candle's not finalized. So not much to extract or take from there at this moment in time. But what I'm going to do is, and I'm coloring up lately, I'm keeping it very simple. But I'm going to add some simple levels, but I'm going to add more levels to watch. And that's about roughly here, 435. Let's make it yellow. Let's round it off to an even 435. It's really a little bit below. It's just the recent lows of this trading range right here. You can very clearly see it. You can box it in. And that's in my opinion, very big support, because it's a lot of things other than it's clear, very visible and clear price support. You can see it was resistance. Then it's the post NVIDIA gap at the bottom of that, which we've been testing for the last, since that day, since it was Tuesday or Thursday, the 22nd. And so big level to me. So there, I added it. Again, if you want to get it precise, go down to the lowest point in that range, which is about, and that's that same day's low, about 433.70, and then set a price alert. Time permitting, depending how quick I get through what I want to get through, I'll go over again the stocks formerly known as the Mag 7 and go over those levels. Again, I've been making it very simple with the colored levels, yellow being the most significant. And but again, I've covered those quite a bit recently. You can click on any of the recent videos and see those levels. I might have even, I did get out some static charts to you earlier this week. Okay, trade idea. Let me just, in no particular order, because I don't want to forget, CARA, still very much an active trade, still very much has to clear that, a big pop. I followed up in the comment section that day that we had resistance at the, where is it? Was it based on the daily? Yes, there it is. There's my targets. That day, any stock I talked about, when you fall under the $1 level, that then becomes kind of a very, very significant level, or a company face delisting. But this company reports on Monday. The chart is constructive. The breakout was, verified on volume. So, it's up to you. I just have to disclose. It's number one. I threw all the disclosures out, but it bears repeating. Penny stocks, anything like this, any stock trading below $1, has a much larger amount of risk and volatility. So as I think I said in the initial post, take your position size down. And then if you are, it's almost an oxymoron for a trader, but if you're risk adverse, then you don't want to hold into earnings. But to me, again, there's, it's a buy signal. It happened far enough in advance of earnings, and I think it's worth it. So I'm going to maintain this trade right now. I'm not going to close it out early. And those are still the targets. Again, just don't take home any more after the close today than you can afford to lose if this thing just craps out. Penny stocks. Here's a good example. There's a drop right there. I don't know if that was earnings, and in one day the stock went down 50%. So if a 50% drop in the stock is going to wipe you out, don't trade it. Do not trade. Don't trade penny stocks. That's an extreme, but it happens. And here's another example where it happened. That was a drop of about 30% in a day. Okay, I think my point's made. Risk and reward go hand in hand. You want to shoot for a stock that has the potential from where we entered it. If it hits my final target, 200%, take a 50% loss. Will give you 4-to-1 RR if that target's hit. Okay, enough on that. IEP, I told you I exited right before T2, and then I also put a post when it hit T2 that I had arrowed down. I expected a pullback, and it did. And then I highlighted again. So if anyone's in it, let me know. But it, highlighted it as another objective entry. And earnings are out of the way on this one. I think, I moved that line. I think they already reported, if I'm not mistaken, or would have been today. I don't know. Like I said, I'm out of it. So, but what I wanted to point out, it's still, it never did hit the final target, and it's still back and remained above entry. So, anyone targeting any of these other targets, it's still objective with a stop somewhat below that 1890 support where we first entered it. And remember, this was a quick get in, get out, and put the arrows, high probability of a pullback when T2 was hit. Hence the reason I got out of it. No, day or two early, but 19% quick gain on that one. And again, you can recycle in or not if you don't like it. So that's CARA. Let's talk about natural gas real quick, because that's one too. We still have those divergences on the 60, but remember, natural gas and any stock, any security, this is a commodity, any security can burn through divergences. We're coming off a much bigger divergent low. I covered the weekly chart recently in the long term, maybe it was the daily or the weekly, constructive and down at the low end of the range. So like a penny stock, if you will, that's where I'd really put, even though natural gas is not a stock at all. But it has that volatility of a penny stock, except I always say, the risk of penny stock is a sudden bankruptcy declaration. They come out and declare Chapter 11 bankruptcy, or, in a biotech like CARA, they got a drug in pipeline, and then boom, FDA shoots it down in phase 2 or phase 2 clinical trials, whatever it is, and the bottom falls out of it. Well, natural gas is going to be around. It's always going to be needed, at least for the foreseeable future. So you don't have those risks. You're not going to lose everything. And if you buy it down towards the bottom of the range, worst case scenario, of course, again, there's some pretty big volatility and drawdowns, but it's not going to go to zero. And it just may be dead money for a while. But and just want to point out, we're still above. That's where I suggested a tight stop if you're swing or trend trading. The trend line a little bit below the trend line. There's some price support, and remember, this was also on the future. For you futures traders, there's the trend line. That was the, I think, first target. I think we took it after this breakout. I'm trying to remember where it was first highlighted. And then that was pretty big, and still is. It was a downtrend line resistance. So this was, bottom line is breakout one off a divergent low bullish. Breakout, hit the trend line and helped to validate it, pulled back. It's been buying, buyers have been stepping in on this uptrend line, breakout, and so far just a pullback. Again, we have, and again, would be remiss not to point it out, divergence. Divergence is not a sell signal, but it is a, hey, if you were happy with the whatever, I don't know, 10, 20%, I don't know what this thing did already, 13% or so, you can take the money and run. But I'm going to keep it on right now as an active trade. And then the other one is crude oil. That, starting about 2-3 weeks ago, I said to watch this level was right here. I added a trend line today at 80.25, but this was really the level I've been watching. Most important, we had a couple spikes through it there, but most importantly, these reaction highs. This is the futures CL. We popped it today. That's bullish. Now, like nat gas, still has divergence, but again, bears repeating, divergences are not buy or sell signals, they're merely indications. Momentum is waning, and you may get a trend reversal, but we're coming off a pretty big divergent low, and the price action has been bullish lately. And I think as long as at this point too, especially if the stock market continues to rally, that would imply the majority of participants predict future economic growth will remain strong. We're not looking at a recession, so I think you're going to see more and more. Either way, I like the commodities. I threw out DJP as a trade idea the other day. That's a commodity, broad-based commodity ETF, and it has a big component of crude. So where I'm showing you too here is crude and natural gas are moving. These are inflation. Nothing that you can watch in real time, day by day, tick by tick, has a bigger impact on inflation, the CPI, than crude oil. So that's it. As I just want to say, I added another line here. These are the futures, tick, tick, tick. We had a couple, support there. But if we can keep piling on through, this is where, I did my little yellow and orange zones and red zone on IEF recently, the 10-year Treasury bond. This will probably be the yellow zone for crude where the market starts to take note. And then if you continue on up, it'll be that kind of rut row moment that, market's rallying, still hoping Uncle Powell will give them what they want. But Uncle Powell's going to have a hard time doing that if inflation numbers start heating back up again. I'm just toggled over this. I just saw a level I should have. You got to be careful with these longer term, the higher levels. I do this for convenience for those trading UNG. I told you I much prefer the futures. A great example is we were in here long there and the breakout occurred on natural gas futures. But if you waited and you didn't trade natural gas futures, you had to chase a breakout, which is really not objective. It was a big gap up on UNG because the futures are trading around the clock. And then UNG opened at 9:30 a.m., gapped up, and then boom, you bought the gap, you would have immediately been underwater. But in futures, you would have been ahead of it. All right, so, USO. There's the crude E10. That's what I was toggling over to. And this is the level I showed you. Actually, it's best on the daily, I think. Daily's clean. I've covered this many times recently, but it just bears repeating. It was a major reaction low right there. So this is not a random level. It probably should be yellow for the significance. Major reaction low, tested, held, and then boom. When it gave way, it was powerful. There was a big gap down. They rallied it back up, tried to make another run at that level, got smacked down. Try to run at it again, smack down even harder. So that is a very significant technical level. And USO has, less decay, tracks crude pretty well. Again, these levels line up with what I just showed you on crude futures. And so rallying up again, nope, boom, breakout today, boom. So we are in that yellow zone now. And, every incremental move up now, especially if these divergences get taken out, which wouldn't surprise me in crude, especially if the market keeps rallying. Because lower interest rates fuel the economy, fuel growth, more people taking vacations, booking flights on planes, renting RVs, going out west, burning gas. So oil is, and that's just one thing. Let's forget about everything's kind of quieted down a little bit recently in the Middle East. Over there, it's there'll be another flare up, and that's that, guys. So this is kind of again. Keep an eye on it, trade it if you want. It's certainly a tradable trade idea. Okay, let me roll into the sectors of the S&P 500. So you have the S&P 500 again, eking out, marginal new high, trading, in this same similar range. And I'm going to put is this my clean board? No, here's my clean board. Oh yeah, I already had the yellow leveled on SPY. So, basically below, just like SPY and QQQ, a break below the NVIDIA earnings gap should do the trick, in my opinion. Again, time permitting, I'll get to all the big tech stocks. But let's go through the sectors real quick. So I did this for you as well. I was going to put static, screenshots on these charts, but it just takes a while, and I think it's more efficient to talk it through in the video and give all the little nuances and things that you might want to look at. And so you already have my yellow levels on the big market leaders. You also have my key levels on IEF. I told you there, the green zone, if we get back in there, the new modified yellow orange zone. We're still in the yellow zone. I'll get to that in a minute. But here's the S&P 500. So you have S&P 500 is comprised of 11 sectors. Those sectors are not equal weighted. There is an equal weighted S&P 500 ETF, and of course that's sucking wind, compared to the regular one. It's come up lately, but it's still, when I talk about that, it's still below its previous bear market highs. So and big divergence. Oh, look at that. So it's in an uptrend and no sell signals. But when do they come? Well, that's what we're going to do right now for the S&P. So, of course, you have the S&P right there, the primary uptrend line, and it needs to take that out. That's right here. There's your primary uptrend line off the October lows. We had, again, a pre-NVIDIA earnings one-day whipsaw down through there, and we're still right above it. So that certainly make it yellow, or I put on my clean board, color that yellow. And I would suggest doing this. And it's real easy, depending on your charting platform, set a price alert, and that's it. And the way it's going to work, as I said, it's not any one. I'm going to get to Apple today and show you why I'm talking about, it's collectively in the majority. If you see these breaking down, that's when you're going to get the next, not only objective short, but what I call a high probability sell signal. And I'm a little excited when I went over the last night. I started going over the sectors of the S&P. I hadn't done it in a while, and I started putting these lines up. I've seen this in the past. It doesn't often line up like this. Out of the 11 sectors, and I'm going to go through them right now, you'd be surprised, or at least I am, how many have nice, clean, well-defined, or pretty well-defined. Again, a lot of them, especially tech, has a little pre-NVIDIA whipsaw, which again, take with a grain of salt. But I'm going to put another level. Well, you can see a support level there in 197.19, but there's the yellow line. So XLK is the tech sector ETF. Last time I updated was end of 2022. I need to do it again, but it has for years now. It used to be energy was a big one, financials were a big one. Now it's in recent years it's been tech being the biggest sector of the S&P 500, and it's again back at the end of 2022 it was a 26% weighting. So over 1/4 of the entire returns of the S&P 500 came from just one sector. I wouldn't be surprised if it's higher now. They try to rebalance out every now and then, and they do, but either way, there it is. So guys, let's keep it simple. That line comes off the October lows, very easy to replicate. If your lines aren't matching up, make sure you're on log scaling, not arithmetic, aka linear scaling. Make sure you're on log, or aka semi-log. And there's the boom, boom. Again, you're going to have to clip that little pre-NVIDIA one. You have enough reactions, it's very valid. Set an alert there. As I'm going into, I started to roll into them, but here's what I wanted to tell you. And this is, I've talked about this. Others have talked about it, but the market dismisses it, and that's fine, because the very, 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 very vast majority of market participants have no clue what they're doing. They're retail investors, dumb money. Now, there are a lot of professionals on Wall Street. They manage a lot of money, but if you add up all the Joe, your neighbor, and the guy that cuts your yard, and the girl that does your hair, and all that stuff, they collectively, there's a lot more of them, and so that's kind of driving the market. That's the herd mentality, pushing things up. And so here's where I'm going. They're out of the 11 sectors in the S&P 500. Only three are have taken out their previous bull market highs. In other words, they're still technically way off, or off. I'm sorry, way off, not way off. Off. Their pre-market high. This is the highs. We all know what happened. We all know that this is almost exclusively due to a handful of stocks. That's been very well documented. It's not opinion, it's fact. What they call the Mag 7, and then fewer and fewer there. I'm going to get to that in a second. So again, 3 out of the 11 sectors in the S&P 500, I'm going through them all right now, are still and never have taken out their previous bull market highs. A bull market which I maintain ended in late 2021, right at the beginning of 2022. For the S&P 500, it was right from the gates, beginning of January. This one, obviously, we know it did, but there's your previous bull market high. There's your line. Bottom line, I wanted to give you lines here. So that is, by the way, 27%. 3 out of 11 is 27%. So one quarter, just a hair over one quarter only of the stock sectors in the S&P are actually at multi-year highs or above their previous bear market highs. Next one up, XLV. And those that are, here's one of the three, obviously XLK. The technical posture, by the way, I didn't expand too much on XLK, but you can see, and I've been talking about it, it's just a mirror of QQQ really, because of the same weighting of the, big overweighting on the top components. Just big divergence that keeps building. And I know. When the divergence is going to play out. They're going to play out, I'll tell you, the timing on this is divergences aren't a buy signal. They built, and you get a little correction. That played out for a pullback. Then it kept going. The divergences continued, and then it finally played out for the top. And we had early sell signals back then on the 60-minute chart and everything else. This is XLK. It's not the market. So when and if and how much these divergences play. Well, the when part begins when we break all what I'm doing in this video. I'm going to keep very simple. 11 sectors. You have yellow trend lines. Replicate them. Just about all of them, at least on the ones that are at or near new highs, they come off the October lows. So very easy to replicate. Very easy to set an alert. And if one day out of the blue, you sit down at your desk or you're out in on your phone, work, wherever you are, and you start getting one alert, one sector breaks down, not a biggie. Check that sector. It might be like today, I had an alert trigger on one of them, but it was at the open, and it was just the opening imbalance, and I'll get to that in a second. But if you have a period, one day or within 1 week, where several of these, particularly these big ones that make the biggest difference, the biggest impact due to their mathematical weighting, like XLK, boom, boom, boom. And I've been here before, and they all start firing off like popcorn. We haven't gotten that yet. Again, we keep walking up. We're holding the key levels I need to see to get aggressively short. But that's it. There's XLK. Let me move on. XLV, healthcare. So you have this massive range. You can see this like purple circle I have. It's really this big old, fat sideways range. There's the top of it. Boom, boom, boom. Every time we got up top, that was a divergent high. I don't have the DH there, but you can see that was negative divergence. The next high popped above the previous high. It was a marginal new high, but it occurred with negative divergence, even bigger divergences than at the previous high. So the divergences, they started forming back here, right? Equal to lower highs on the indicators with higher highs in prices. That's negative divergence. Boom, shot you down to the bottom of the range. Wasn't random. You had a divergent low at the bottom. You shot up to the top. You even popped, made a marginal new high, but the divergences were in place because you even had equal or lower highs, lower, equal, or roughly in higher highs and prices, and you went down, even down through, shot through. It was a whipsaw, a brief break. You just shot right back in the range, tried again. So that really established a new bottom right there. But this was the bottom before. I know this is my busy board, but you can see key levels in yellow, right? 120, we call that 124. So many reactions for the last few years. So this is a go nowhere. If you had your money in the healthcare sector, 1, 2, 3, for over 3 years now, you've made almost nothing. You're up on the top of the range. Top of the range is 142. We just broke out, so I'll give it props for that. You're up a whopping 4%. Factor in inflation over the last 3 years. Taxes if you took profits here. That's where you're at. And that's, of course, that's if you bought the top of the range. If you bought the bottom of the range, obviously the number is going to be anywhere in the middle if you've been averaging in, or 20% from low to high. Again, over 3 years, you get almost that in a money market right now, with no risk. But here's the takeaway. This is one of the three at new highs. It's taken out its previous, which is really technically right there, its previous bull market highs. And it's very much in a technical posture that I would put good odds. Good odds mean well over 50%. Don't ask me for a number. I'll say 70, 80%. This breakout's probably going to fail based on the technical posture, the divergences, all that. And if it does, then this is the new whipsaw. However, it's simple. There's a trend line. There's a yellow trend line. This is the one I threw out an alert this morning at the open. But again, we're right back above there. And I can tweak the trend line because we had a little red candle yesterday, but close enough. You get it. And that's why I don't, like I said, if you got an alert on XLV, do you turn around right there and short XLV? No, you look at everything else. The rest of the market, the index itself, the S&P 500, is it holding up above trend? Yeah. Are those Mag 7 collectively? You need, I like to use these analogies. I'm not a lawyer, but you watch TV and all that. And in a court of law, innocent until proven guilty. And so the burden of proof is on the prosecution. And, if you want to get a conviction, you have to have a overwhelming amount, guilty beyond a reasonable shadow of a doubt. Okay, so when you're looking at a strong trend, same thing here. And so what I'm just showing you is the more of these trend lines that break, the better case and the higher your odds are going to be that if you get, put on a good size, on indexes, again, if you want to trade the indexes or any one of these sectors or even any market leading stocks, you're going to get the most juice out of shorting NVIDIA and Microsoft and Meta. They'll fall harder than some others, in my opinion. Or you can take the safe bet, short QQQ or whatever you want, and not have to worry about navigating earnings and all that if you're going to try to trend swing it down. Okay, enough on that. There's number 2. We're right at the trend line. Again, you want to tweak it, might as well. That's it. So there's your trend line. Comes off the October lows, very well defined. And again, it's these divergences that tell me that breakout is likely to fail. So that's sector number 2. And only 2 of 3 that are at. Here's the financials, still well off their highs. They peaked back like the stock market in the beginning of 2022 right there, and at 2021, beginning of 2022. And they're in an uptrend right now, a near-term, intermediate-term uptrend. They had this big symmetrical triangle they broke out above, but clear negative divergence. I won't mix words. This is a very nice-looking short setup. You can short these individually or you can short the market, because if I'm making a case right now, the majority of the sectors, especially that have the highest weighting, I should have said that in the beginning. When I go through these sectors of the S&P 500, I go through in an order. I sort my watch list by their percentage that they weight, the weighting in the index. So now, and that was again XLK. My numbers might be a little stale, but 26% back then. Healthcare is a second, about 16%. Again, you can update these numbers yourself. I'll probably do it soon. You can just go to S&P SPY's website and get them. 12% on XLF. Again, still off, not far, but still off its highs. And again, a beautiful bullish falling wedge that whether we make it up there or pop it above, I would put very good odds. But again, I wouldn't short it right now. I wouldn't short, if I had nothing on the market. If I woke up today and I had a blank slate in my accounts, no positions, all cash, wait for these. These are the levels, set these alerts. And again, they're all right there. So you're probably going to see some event come up soon that triggers and then, one goes off. And like I said, one goes off, that's not going to take the market down. It will certainly hurt to see XLK break down, but if you get 3, 4 of these, especially these top sectors all breaking down, solid sell signal, especially solid closes below, I'm going to put pretty high odds. And then that, to me, helps determine how aggressive I want to get on that position. Okay, so that's XLF. Another one still below its previous bull market highs, as is XLY. This is consumer discretionary. Again, a little stale. I haven't updated the percentages of Amazon, Tesla, Home Depot, Nike. 10% weighting. This is the 4th largest. Again, story of the market, just like the vast majority of stocks. Remember, this is just over 1/4 or over almost 3/4 of the sectors in the S&P are still, you want to call it, I don't want to get into semantics, bear market, whatever, but they're off their bull market highs and what I believe to be, bigger bear market longer term. And again, it's simple. Do you short them just because you think they're in a bear market? No, right now on the XLY, there's a trend line. Again, comes right off the October lows. Again, big divergence. Last time we had a clean trend line like that, even in a intermediate bull trend off the January lows right there, beautiful little bullish falling wedge, complete with the negative divergence I like to see. Nice clean trend line, big red candle when it broke. It didn't just meander on through there. That's what you want to see. That's a high probability sell signal. And, don't second guess it in the first little. They're going to buy. The dip buyers, is Pavlov's dog, they're going to step in. But if you shorted that, that breakdown there, I'm trying to not grab the trend line. There it is. That was a 15% drop over several months. It would almost certainly shook out any long. And then you had another sell signal when this breakdown of this trend line came. And then almost a divergent low, but not quite. But either way, this is it. Big old wedge. Measured target of that wedge would be the widest part of the wedge, just to give you an idea. That should, that initial rundown or the wedge breakdown, even if you're bullish looking for new highs in this, that's where that measured target would take you down somewhere around that 168 level. So there it is, sector number 4, fourth largest. Next up is industrials. This is one of the 3 that have recently punched out to multi or all-time highs, multi-year, same difference because everything else peaked a couple years ago. Beautiful little bearish rising wedge pattern, and again, not by mere coincidence, a nice, clean, well-defined, lots of reaction uptrend line off the October lows. There's your negative divergence. Last time you had a nice clean uptrend line with the divergent high was right there. It wasn't a very big divergent high, but it was enough in what I believe to be a larger bear market overall in the entire stock market, take you down 13%. That's swing trader. And then as a swing trader, this was time to get long. You fell to a very, very good support level. I had that level there. Let's see, yellow line. Created that back in May 20th, 2021. So that line I created way back here. And that's a level, had I been, I wasn't in this particular one at the time. But if I would have saw that's an excellent support level, positive divergence, that's my kind of setup. And then you would have gone long there and boom. So that's it. This is swing trading and trend trading. These are the trends. And the next trend will come, start. We're in an uptrend. That trend ends. And most like a new downtrend will begin when this yellow trend line goes. Again, all the better if you have several go around that same time. And of course, you can see some levels there if you want to trade it individually. All right, next up is XLC. Still, back down about a 7%. There's your uptrend line, October lows, negative divergence. Another sector still yet to see its previous highs all the way back from, mid, 2021. That was the beginning of late August. Yeah, late August, August 31st of 2021. Still there off that. So this is what, bigger picture stuff looks like. And most people just don't, take a long-term view of the markets like this. And again, but that's, I'll talk all day long of where I think things are going long-term. You got to, you need these to get positioned for it, especially against a trend when you're trying to, call a turn. You got to get these sell signals. And I'm sharing these. Again, I've already shared for weeks now, even months now, the purple lines, which never went. In fact, we went long off those, off the big market-leading fangs late last fall. That's where the big rally that is still going on right now stem from. So we didn't take those out. And so those, wondering, hey, when you're going to hit the long-term targets. Well, the if and when depends on when those levels go. That's where, to me, the odds then jump well over 50%. These yellow lines, as far as a bigger picture, certainly increases the odds of my longer term outlook, 40-50% drop in the indexes. But it's going to at least trigger an initial swing target. I'll put some swing targets for traders just looking to get a double digit drop and maybe cover and then game a bounce. And also, and I've always said this, if I think, big picture, the stock market or sector is going, down here, let's say it's a 30-40% drop, even though I have accounts that I don't actively trade or less actively trade in, IRAs and all things like that, I'm rarely, short the whole time. This is how I trade it, and this is what I do on the side. This is what it's all about, swing trading. Game the bounce right there off that first support, especially if the chart's confirmed at the time. Go there, game a bounce off that next support level. long short. So on quite often on a 30-40% drop, my net return can be 60% if I'm sidestep the rallies, the counter trend rallies, and turn around and even make some of those profitable on the long side, and then reverse back on a short trade, and ditto or vice versa on a bearish bullish trade in an uptrend. Okay, we're almost done, guys. This is and remember, when we get down the line, I'm going to click on the next sector now, XLP. The weightings start to get obviously less. So they have less of an impact. This is back in the day, these were all your big blue chips. Procter and Gamble. I haven't updated this in a while. Pepsi, Coke, Costco, Mondelez, Philip Morris, and Walmart. And you can see same thing. There's your uptrend line off the October lows. Nice, well-defined. Negative divergence, plenty of resistance. One that you can, it's whether it's in a bull or bear. Again, semantics. Who cares? This is, these are lower highs, and if it reverses below this one, what it has to do, bigger picture, and that's where you go to the weekly chart. You got to say, okay, here's a weekly chart. Here's the consumer staples. You can see on my weekly, I have a primary secular bull market uptrend line off the lows here. COVID was what I nicknamed Ursa Interruptus. It was a bear market. It was a bear market, 36% drop in the S&P, but the central banks pulled the nuclear option, wouldn't allow it, or we would have most likely gone into a deeper and more prolonged recession and bear market then. So either way, that trend line's still valid. We punched through it and then it snapped right back above it, and we still have a lot of reactions. This is a breakdown of a secular bull market uptrend line. Within that secular or bigger bull market, we've had plenty of bear market corrections off these divergent highs. This was the high, and I maintain that probably marked a generational high for the consumer staples sector, which broke down here. It's still in a downtrend or a bear market, again, if you look at it that way from the highs, and then it will continue lower with the market. And again, these are the bluest of blue chips, but nobody wants to own these anymore. Everyone wants to own the AI, which again, to me, and we'll see. Time will tell. I know I can see some of the merits of that. I don't want to talk too much on it, but I follow that stuff. I've tried Microsoft Copilot and Google's Bard, which is now Gemini, and and I know people are finding value in the AI stuff, but again, it's when it really starts hitting the company's bottom lines. Right now, it's just the hype running them up and whatever. It's just another iteration of the technology we've had for years. But okay, let me get to a few more here. And again, I don't spend a lot of time. Energy sector, XLE. Let me get back to my daily chart. So this one, and it's funny because the ones that you don't want to see go up, if you're a bull, an equity bull, let's say you're all into this AI thing, tech, and 401ks all in S&P 500 or NASDAQ 100, the sectors you don't want to see go up, especially are these basic materials and energy. We're on energy right here because obviously if XLE is going up, crude oil, natural gas, that's where they're making their money. And this one is more bullish than anything, coming off a divergent low. Of course, it's still off its highs. It's another one of the 8 out of the 11 that it's still peaked back in 2022 or 2021. But again, it's holding up, and that just shows you the sticky inflation kind of thing here, right? And if anything, this is one to go long. This is a resistance level. Remember, it came off that divergent low support. And I just want to mention it. So I don't have a yellow line there. In fact, I would, to support the bear case, if I start getting breakdowns on the sectors that matter and have the biggest weighting on the index, like I said, tech and healthcare, that's going to bring the indexes down. It would only help to support a swing or trend short case if energy kept going up, because that would really put Powell's hands in a bind as far as, that whole sticky inflation thing going on there. So I just wanted to point that out. So I don't have a line for you there. If anything, it's a long. I'm on a pop above 88, and I already gave you my update on crude today. So keep that in mind. XLU, utilities, they're not going to move the needle. But if anything, there's a downtrend line. And so I don't have a yellow uptrend line. And they're also generally a defensive issue, meaning during a recession and bear markets, people tend to buy recession-proof stocks like utilities, because the last thing you're going to stop doing, you might cut back on your Netflix subscription and all that other kind of stuff. Maybe not upgrade to the latest and greatest iPhone, but you're going to keep paying your power bills. So these guys are recessionary. So that one again, I don't have much of an opinion. If it breaks that, it's got intersecting price support and trendline support there. It's clearly in a downtrend, a bear market, but anyway, so again, it's not going to move the needle, and it looks, the ones that look the most bearish to me are the ones that are at or near new highs, pushing this market higher right now. And again, to repeat myself 100 times here, it's these yellow trend lines. Here's one right there. XLB is basic materials. Again, this is inflationary as well to an extent, but remember, these are the companies. This isn't holding a basket of basic materials. These are companies that produce basic materials. Are in there. You have copper, steel, cement, chemicals. Those are the companies in here, and they're beneficiaries of an inflationary environment and commodities, rising commodity prices. But again, they're also stocks at the end of the day, and so they're subject to a drop. And there's your trend line right there. So last not least is XLRE, and again, we all know this is clearly in a downtrend bear market, and that just I don't think we've seen this. It's probably unprecedented, the divergence between the stock market and a sector like this. We know this is kind of zombie land here, especially CRE, commercial real estate. I'm sure you guys read up on all that and this whole, what do they call it, the refinancing wave coming up. A lot of companies due to refinance over the next year or so. And so that's why I'm going to segue now over to what I want to continue to keep on my radar here. IEF, yellow zone. Here we go, guys. We're right up to there. So I'm going to make a micro prediction, making very short-term calls and predictions on things that haven't happened yet. It's a fool's errand, but call me a fool. So this is what I told you back here. I said, bullish falling wedge, positive divergence. That breakout, you can take treasuries long to offset any shorts if you have been scaling into shorts or own any shorts on the index, because if bonds went up, the market would go up. And that's exactly what happened. And this technical said it would, especially after the breakout. And so we're there. That was my target. That was my plans. Get up there. That's most likely where the rally will end. I can't guarantee it. I can only tell you that if we punch on through well above the top of my yellow zone, it's going to be, again, net bullish. Net doesn't mean guaranteed, but it should be net positive. That means lower interest rates, right? That's what that means. This means higher rates, and yesterday I told you I dragged my orange zone, which used to start right below the yellow zone, and I moved it up now. Now that we've established, we traded for a couple weeks right there on that level. If we get A, rejected here, which is my preferred scenario, that's what I think will happen, and then B, go on to take out those recent lows, that will, in my opinion, coincide with a breakdown of those yellow levels I just gave you. The timing on it, again, what I do, what I do every day and give you these levels, I give them to you in advance, not in retrospect or after it happened. So the timing part, it's hard to say when I draw these arrows. They're not scaled to the exact time. They're just, hey, this is resistance. I think the sellers are likely to step in here soon. I mean, we're close, maybe a hair below it right now if I zoom in really tight. Close enough. And so if you get a reversal there, well, number one, that should, probably come later today into the close or next week. We could trade there for a couple days too and then do it, or we can pop above. I mean, there's a million different scenario. We could pop above and then fail it. So the thing is to react. I predict and then react to it. Predict where we're going to reverse. If we don't reverse, then I react. I just, give it a little room if we pop above there. And then if you're shorting treasuries, for example, then you might want to start scaling out. You should. That's resistance that we shouldn't get into. The seller should step in here soon. And if they do, again, it may not have an immediate impact on stocks. So far, stocks have been trading to these moves in treasuries, including today. But then that's the level that I think will now do the trick. That's why I upped that orange zone, because we've had that level. And again, the orange zone doesn't mean the market crashes, but it starts to really take note. And it did certainly take note of the rising yields. We had, pullbacks and corrections and in the market when we got into the yellow zone, and that's it. So there's the trading play. And so if that happens next week, the rejection, especially the breakdown below the recent lows, that would be a pretty good move. It would wipe out, when was it? We broke out here on Friday the 23rd, a week ago. So it's been 1 week to get up here. So the thing about stocks and bonds and most securities, they tend to fall faster than they rise. So that drop there, it took this long to get up there, and it was wiped out right there quickly. So that could happen. It could be next week if it does happen at all. It could be the following week. It took a week to get up here, but I'm thinking sometime next week, most likely. And again, it all comes together. You set alerts. I'll do it right now. I'm going to set an alert here, just so in case I fall asleep at the wheel. About 93.43 roughly, I set an alert. So next week or 3 months from now, if this alert goes off, and XLK price alert goes off, and XLV and XLF, and enough of those, then boom, I'm going to get very quickly aggressively short. The other thing, and to wrap the video up, is let's not forget about the market leading, again, FKA, formerly known as Mag 7, gave you those levels as well. So it's very simple. And again, this is that whole, building a case, having as much evidence as you can. I have price alerts on all of these already. I've already shared the yellow levels with you, but let me share a statistic as well. So 1/4, just over 27%, or I should say the other way around, depending on how you want to look at it, 73%, or nearly 2/3, 3/4 of the S&P 500 sectors are still below their all-time highs from put in over, 2 years ago now. On the Mag 7, formerly known, whatever you want to call them, 43% are trading below their all-time previous highs. So you only have the only ones that have broken out to new highs recently, that put in a new bull market high or whatever, have taken out the bull market, end of the bull market back in, most of them peaked back in 2021. It's only Microsoft, Nvidia, and Meta. Apple, and that's the one I want to get to, and I'm going to wrap the video up here. Apple, Amazon, Alphabet, and Tesla are all still below the peaks they put in back there around 2021. So that's by the way, that's 57% below 43. And again, I'm just giving you statistics, taking what we want, but it's, to me, again, it talks about that narrow market breadth. It's almost all this guy right here. It's almost all NVIDIA. And of course, Meta's done some heavy lifting as well. And now let's wrap this video with Apple. So the other day I shared, and I've just very, very clear and repetitive on my thoughts that, hey, it's objective, but I'm not taking it because I don't think it's going to play out. If I thought there was a good chance it was going to play out, I would. But I've gotten a lot of, almost angriness on this board from, why didn't we catch every bit of the rally off the 2023 lows? Even though we were long there, I was long person until we get long. Nobody stayed long. And again, I know people have different opinions, so I put these trade ideas out for you. And if you are bullish, because obviously several here have been recently saying buy every dip, we're going to the moon, then that's all, and you take it or pass. Now, what I wanted to share is we broke down. And I've been talking about this lately. This is now. Is it an all-in short moment for the market? No. For everything I just spent 30 minutes talking about, there's everything, all the keys, all the big sectors, the ones that count, all of them are right above key trend line support on the S&P 500, all the sectors. The majority of all my other Mag 7, we'll call them stocks, are above those yellow levels that I gave you in recent weeks. And they're all still, of course, above the more significant purple levels. So, and do you short my Apple here? You could, and I'll just say in a vacuum, absolutely, you can make an objective case. That's a major support level. It was taken out, and I don't have to squint to see it. 180 was a support level I've been highlighting. Right up above that are the 200-day simple and exponential moving averages taken out again. But, and so, look, I'll keep it simple. Yes, it is an objective short. Is it a high probability short? It's close because I think the others are on the verge of breaking down, but they haven't yet. So at most, I would do a starter position. Again, if you were inclined to short Apple, I know most aren't. It was former crowd favorite. It still is. It's not super far off its highs, but I just want to point out this is very technically significant. It could be a whipsaw. You can see I took my divergent line. This is the divergence line. And quite often, especially in a bullish uptrend, you see these false breakdowns. So we still have the divergence. If we go much lower, we won't have it anymore on the PPO, and a little lower than that, we will not have it on the RSI, and that's very bearish to see divergence taken out. Remember, these divergences, I know there's some critics on the site, and I always say they're not the be-all, end-all, but just look at all my marks here. Divergent low, you got that. And we traded that, and we were trading down short into it. Divergent low, there. So these are when quite a few trade ideas were posted. This is swing trading. Divergent high, that. Divergent low, that. Divergent high, that. Divergent low. If that doesn't happen, and again, for the reasons I've been stating, I'm not a pure mechanical trader. Some people are. Don't violate your trading rules. Don't second guess it. Take a buy signal for what it is. I'll tell you. I always tell you which ones it's subjective. It's a breakout, but that's what I try to do. Predict which breakouts are going to fail and which ones won't. This one, I think, has a decent chance of sticking, and that'll go to an excellent chance of sticking if in the next, it needs to happen soon, if by next week we get at least several of those other sell signals on the market-leading Mag 7 I just went through, and the sectors in the S&P 500, especially the important sectors. It doesn't matter what REITs do. It's not going to affect Apple. All right, so that's it. And for those that do trade individual stocks or are a little more aggressive, remember it's a Friday. Whatever you take today, new positions you enter today, it's now noon, almost on the button. If you take a swing position today, you're going home. You have 2 extra days overnight risk, but I would put the risk on a gap down. We're on those trend lines, and we're not just on them. We're on them, and they're long in the tooth, overbought conditions, negative divergence. So to me, breakdown appears imminent. And again, I'm giving you a micro call prediction that I think next week, boom, they'll fire. Do you go heavy short now for that? Even if you agree with it, no. But you can certainly take a starter. This is a big one. This will have psychological impact, and I guarantee I'm not the only one looking at Apple taking out the 200-day and those levels. Maybe a one-day wonder. We'll know next week. And likewise, if you are a bull, the way that works is you don't go long on a breakdown. You maybe sit tight. Maybe if you took it last week here at support, give it a little room. The next support's down here. Wait and see next week. Maybe the market continues to hold up, stay above those support levels I gave you. And then, so I wouldn't add here, but you could add on a solid recovery back above 180, because then this will be a whipsaw, aka bear trap. And then even better, which will come in around the same time on a breakout above the downtrend line. So it's still the same setup I gave you the other day. 2 objective long entries at support at 180, and or part means and if you're scaling in, you take a partial position at 180 and on a breakout above the trend line. Or means, okay, you don't want to buy support, but you want to wait for a breakout. That's what when I say and or, that's what I mean. Those are 2 different points. And I typically like to, not all the time, sometimes I'm hard in on a position, full position at once, but sometimes, quite often, especially when I'm given the benefit of the doubt, I'll take, scale into position, average in. And I do it strategically, not some people look to average down on a position just to lower their cost basis. My entries are usually pre-planned. If I plan to average down, pros usually average up on a winning position, and it's the dumb money that usually averages down to lower their costs. But I will do it if that's a predetermined plan. If I say, okay, my scale-in zone, I'm going to start buying Apple between 180 and 173, but not below. All right, so hopefully that makes sense too. There it is, guys. that's it. This might be the last video for the day unless I see anything big. Oh, God, you know what? In the trade ideas, I had my notes. I got to update them. I like the miners are running. There, boom, we took it out. Remember, I told you my favorite last week, and it was earlier this week. Tuesday's video was WPM. Love that one. Then took out hit. Now it's taken out T2. SIL has now taken out the downtrend line. Remember, this was the silver miners ETF. Nice support there, divergent low. And then GDX also took out its downtrend line. And now T1's hit. So there it is. There's your update, guys. I don't know if I'll bother getting this out to you. I might cut out early today, but T1 hit. And that increases the odds for a reaction. I think there's a good chance. I think there's a good chance. If you got in it last, I started highlighting here the other day on that support. If you made the quick 5-6%, and of course some of the individual miners did more. The one thing that could put the brakes on this or cause this breakout to stall out is, drum roll please, you got it, this. Crude oil is the second largest expense to the miners, just like airlines. Their first largest is salaries. Second largest is fuel, energy, gas. As I like to say, this isn't 1849 Sacramento anymore, where they're panning gold on the surface out of the creeks. This is now, we're digging deeper and deeper in the ground to find it, more energy intensive. And so that's why, fuel is the second largest expense. So that's a net bearish thing for the miners. So charts are constructive. I'm not trying to double speak here. I'm just trying to tell you, if this continues to run, and you can see it's nice up today, 3.3% in crude. That's because that's that level I've been highlighting for a long time. That's short covering. There's a lot of folks that just figure they could keep shorting up every time it hits 74. And when it breaks out, two things happen. Shorts cover because they see, a big resistance has been broken, and then longs pile in at the same time. So unless that breakout fails, that's bullish for crude, which should be net bearish for the stock market. And again, a net headwind, not right away. Sometimes you can have crude going up for a while. So just keep it easy with the miners. I just wanted to say that. That's it, guys. I'm going to wrap up here, and I'm not going to cut out right away. If I see anything else, I'll get it out to you before the end of the day. Otherwise, we will pick this up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.